Every now and again, investors get excited about a new technological innovation which appears to be groundbreaking. Driverless cars are a good example today. Economists sometimes refer to this as new era thinking.
The concept of new era thinking has been associated with Bob Shiller, the Nobel Prize winner. It was Shiller that really first coined this phrase. And it refers to the tendency of investors to get overexcited about new forms of technology when they roll along. And so this would have been true of railroads in the mid-19th century, would have been true of electricity and the internal combustion engine in the 1920s, and then later on at the end of the 20th century it was true about computer technology and internet-related technologies.
When we think about internet companies, it tends to be firms like Amazon and eBay that come to mind. But those successful companies have been vastly outnumbered by firms that flopped.
So the other belief of these new era thinking types of investors is that they can pick those winners. Well, maybe you're incredibly talented, or maybe you're incredibly lucky and you can, but probably what is closer to the truth is that as a group, these investors tend not to pick these winners, or they might pick them, but they also pick an awful lot of losers. There is certainly a huge payoff in terms of the benefits that these technologies can bring. But it was William Nordhaus, the famous Yale economist, whose research has shown this to be true in the case of electricity and also with computing, that these huge payoffs we get in terms of productivity accrue to the economy as a whole, and in particular, the vast majority of those gains accrue to the users of the technology, and only a sliver of the benefits actually remain with the investors.
So why should it be that it's consumers rather than investors who chiefly benefit from technological innovation? Well, one reason is that whenever a new technology emerges in a particular sector, there's generally a huge influx of new entrants.
You get a lot of investment, partly financed by money that's raised during the bubble on the stock market, and that capacity, that new capacity, drives prices down. And so the firms, therefore, are facing this steeply declining price curve, and the gains that investors thought that these firms were going to be able to, that they were forecasting would be able to hold on to during the tech boom, turn out not to be the case usually.
Driverless cars are an exciting technology, but as an investor, you should keep your enthusiasm in check. A much better policy is to diversify across all stocks. And yes, that includes the boring ones.